So, you're living in Europe and want to invest in SCHD? Sorry, it would be safer for you if you didn't. At least, that's what the bureaucrats from Brussels want you to believe. The reality is that they just don't want the competition of the American ETFs. However, their backyard, their rules. The only thing you can do is adapt. Here are two alternative ETFs that, when combined, give you equal or even better results than SCHD, which you can buy as a European. The Schwab U.S. Dividend Equity ETF, or SCHD, has exploded in popularity lately among dividend investors. The main reasons are that it has solid companies screened by certain rules made by the Dow Jones US Dividend 100 Index, which has helped it achieve very good dividend growth at the same time as having a pretty decent starting dividend yield. So, when I was searching for a combination of ETFs for EU investors, I wanted to create something that would replicate these characteristics. Of course, the companies and rules of the indices won't be the same, which is obvious, but the point is to get similar characteristics of a high starting yield combined with solid dividend growth, something I have heard a lot of investors in the EU complain they cannot find in their domestic ETFs. So, let's begin with the comparison. I will start with SCHD's metrics and results, which I will compare with the average of the identical metrics from my two ETFs which I chose. That way, I basically simulate SCHD versus these two ETFs held in a 50-50 ratio. The annual return since inception for SCHD is 13.34%, and for our ETF combination, it is 11.04%. Then the 3-year one for SCHD is 7% compared with 11.14%. The 5-year annualized return of SCHD is 12.89% versus a 10.95% return for our Frankenstein. Now, let's move to the dividend metrics. For SCHD, they are the following. For the past 12 months, the dividend has been increased by 1.22%, 8.56% annually for the past 3 years, 11.8% for the past 5, and 10.87% for the past 10. Since I don't have a 10-year data for my other ETFs, I will input in our spreadsheet 11.41%, which is the annual growth of the dividend since inception. This is compared to 10% dividend increase for the past 12 months, 18.55% for the past 3 years, 10.13% for the past 5, and a total CAGR of 10.46%. The yield of SCHD is 3.49% currently versus an almost identical yield of 3.42%. The expense ratio for SCHD is a tiny 0.06%, which is typical for large USA ETFs and is unbeatable for the EU, as can be seen by the average expense ratio of 0.32% for our European ETF substitute. When it comes to the number of holdings, SCHD has 104 versus 199. And last, SCHD is only focused on the USA, whereas our Frankenstein ETF has a majority USA focus, but also exposure to other developed markets. Okay, after seeing that the metrics are pretty comparable to SCHD, let's end the mystery. In the next part of the video, I will tell you which two ETFs I chose, and I will give you an overview of them. The first one is the Fidelity US Quality Income UCITS ETF, ticker symbol FUSD. The fund invests in companies from the USA with certain quality characteristics, which we will see in a bit. It is domiciled in Ireland and is UCITS compliant, which makes it available for European investors. It tracks the index by Fidelity carrying the same name. This index, with everything I will show you in it, is the reason this is one of the best ETFs I have come across in all the years I've been investing. It's really a masterpiece what Fidelity have managed to create, so let's dive into it. The main screeners are income and quality ones. The income screener makes sure that only companies that pay dividends are included in the fund, but more on that later. Then we get to the meat of the index. What happens next is pure magic. The 3 screeners are quality-oriented ones. All companies that are selected initially are then ranked according to a score that is calculated based on these screeners. Each of them have equal weighting, which means that a third of the quality score is calculated based on each. The first one is cash flow margin. This is a metric that shows how profitable and efficient a company is. Think about it this way. If a company makes $1 billion in sales of a certain product, but only has $100 million left after paying for everything they need in order to sustain the business, it is less profitable and efficient than a company that keeps $300 million from the same $1 billion. The second company will be ranked higher for this current screener. This ensures the companies in the ETF are profitable and efficient ones. The second filter also measures how profitable and efficient a company is. It is return on invested capital, or ROIC. It basically, to simplify it, calculates how well a company uses what they have as assets and money to generate profit. The bigger the percentage is, the more efficient the company is. It shows good management and higher potential for future growth, since there is more money left as profit generated per unit of capital. And the last of the quality screeners is free cash flow stability. This measures how consistent the company is in generating money, and so is an important metric for only choosing stable and strong companies. It is calculated over the past 5 years. Now, these three metrics are enough to ensure high level of quality for all the companies in the fund, and if there were no more filters, it would still be a pretty good ETF. But there's more. The following metrics are also included in the calculation of each score a company gets. First, price momentum, which gives the company a higher score if it has had more momentum in the returns in the past year. Second, dividend payout ratio, which is the percentage of the profit the company pays as a dividend. It shows the sustainability of the dividend. Then, it calculates a score for the dividend growth in the past 5 years. And lastly, for the dividend yield, which is a percentage the dividend is of the stock price. Now, with everything said this far, you can see how only very high quality companies will be present in the ETF. But as if it wasn't enough, there's more. Only companies that have grown or sustained their dividend at the same level for the past 5 years are allowed in the fund, which ensures that no dividend cutters will be allowed to creep into your portfolio. Then, the top 5% of companies in each sector with the highest dividend payout ratio are removed. This ensures even bigger sustainability of the dividends. If you're getting overwhelmed, don't worry, we're approaching the end. Please keep up with me here, as there are so many quality filters in the ETF, I wanted to show them all to you. Next, the 5% of stocks with the lowest momentum in their returns for the past 12 months are also removed. And lastly, companies that stop paying dividends from the ones which are already in are removed almost immediately, which is every month. A lot of ETFs wait for months and even a whole year to do that, dragging down the total returns, but FUSD does it every single month. I mean, just look at everything we went through. This Fidelity index makes sure only top quality companies go into the ETF by having so many checks and filters. For that reason, and because of all those quality screeners, which I haven't seen anywhere else, I have included FUSD as one of the ETFs in my top 4 stocks and ETFs free report, which you can get by going to the link in the description. It is a free report that will be sent directly to your email address. Now, have in mind that the report will always be up to date with the current environment, because I am constantly updating it, and since I have no idea when you will be watching this video, FUSD might have been removed by me. So again, go to the link in the description and grab your other 3 stocks. Now, let's check the top 10 companies in FUSD. Currently, they are Microsoft, Apple, Nvidia, Eli Lilly, Broadcom, Visa, Comcast, MasterCard, Verizon, and Home Depot. What I like is that the ETF isn't extremely top heavy, with the top 10 stocks comprising 29.06%, which is not little, but also not like SCHD, which has 40% in its top stocks. When it comes to the sectors, FUSD has a big technological exposure, unlike SCHD, with 35.31% in tech stocks, followed by healthcare at 12.52% and consumer discretionary at 10.64%. Okay, moving on. The second ETF is the VanEck Morningstar Developed Markets Dividend Leaders UCITS ETF, ticker symbol TDIV. This ETF is domiciled in the Netherlands. The VanEck Morningstar Dividend Leaders ETF follows the Morningstar Developed Markets Large Cap Dividend Leaders Index. So let's check what this ETF and the index it follows is all about. The first thing we see is that it only tracks companies from the developed markets, which, as I said, gives us more exposure outside of the USA compared to SCHD. Then it screens for companies that pay dividends, aren't REITs, and have certain dividend growth and sustainability screens. Companies in the ETF must have either paid a growing or flat dividend for the past 5 years. It cannot be negative. The next very important screener is that the dividend payout ratio has to be below 75%. Then, once all of that has been established, the companies are ranked according to their dividend yield. Here it means that the fund will be skewed towards having higher yielding companies. When it comes to the maximum weight a company can have, in TDIV it is 5% for a company and 40% for a sector. The top 10 companies currently in the VanEck Dividend Leaders ETF are Verizon, TotalEnergies, Pfizer, BHP, IBM, HSBC, Mercedes, Bristol-Myers, Sanofi, and Rio Tinto. The ETF has 36% concentration in its top 10 holdings. It has a huge exposure to financials at 42%, which will probably be trimmed at the next rebalancing because the maximum of a sector is supposed to be 40%. Next are materials and energy at 10%. This is a very nice addition to the top sectors of FUSD. As we can see in this comparison here, FUSD has huge tech exposure, while TDIV has almost none. The top 3 sectors for FUSD are tech, healthcare, and consumer discretionary, while for TDIV, they are financials, materials, and energy, perfectly balancing each other. So, if we make a big picture comparison with SCHD, we will see several things. First, as mentioned, SCHD is very top heavy, with 40% in the top 10 and has 100 companies, while the combination of our 2 ETFs has 199 companies and top 10 concentration in the low 30s. Second, through FUSD, we get a big exposure to large cap growth tech, which we don't get from SCHD. And third, through TDIV, we get global exposure to companies in places like the UK, EU, Japan, Australia, Canada, and other developed markets, which is lacking in SCHD. When I do these comparisons, I always have numerous metrics and facts in mind, and I run the ETFs through a lot of research. To learn more about my investing strategy and how to make real sustainable long-term passive income and wealth, sign up for my free masterclass, for which you can find the link in the description. Looking at the comparison of SCHD and these ETFs, it is important to know that this is entirely made up and you should obviously not expect them to behave the same. They have different companies, follow different indices, and are entirely different investment vehicles. However, because I had received a lot of questions about quality dividend growth ETFs and specifically SCHD from people from the EU, I think this combination does the trick in terms of preserving the quality and giving you the dream combination of every dividend investor between relatively high dividend yield and high dividend growth rate, coupled with market competitive price return. Let me know what you think about it in the comments. And before you go, check this video that should have appeared on your screen already to continue with your investing education. Always remember that none of this is financial advice, and I will see you in the next one.